economics, what's best for the American people, what's best for the economy. And as I talk to the candidates, I'm looking at three things: monetary policy, regulatory policy, and the ability to run and revamp the organization, because it's really gotten bloated, and I think that this bloat puts its monetary independence at risk.
That, ladies and gentlemen, is the Treasury Secretary, Mr. Scott Besson, talking about what he's looking for in regards to a new Fed chairman. Jerome Powell will be out. When exactly, I'm unsure. However, you know, I've actually kind of pushed back a little bit on some of the hate Jerome's been getting, or the discontent towards him, and actually said he's not done such a bad job. I think this may be a case, perhaps, or perhaps not, of better the devil you know than the one you don't. But we shall see who the next Fed chair is going to be. And what he said at the end there was very telling in regards to the Fed being bloated and needing kind of reshuffling and reshaping, perhaps to accommodate this digital world. Major things are underway, and crypto plays a front and center role in it. We know that from what Scott himself has said, Trump and David Sachs. They've all admitted that what we have here is a new financial system being built that's going to run upon the rails of this state-of-the-art crypto, which Trump said himself, and distributed ledgers, which we have known for a long time now. It's all coming to fruition. Talking about the US and kind of economic policy, yesterday we had the CPI print. Now, the CPI print came out at 2.7, which is the same that it was previously. Lots of people worried about inflation and the effects that's going to have on monetary policy. And we've actually said, not really anything to worry about in our opinion, because the trend is still down. Yes, there might be bumps in that road, but generally, as long as the trend is down, we don't see that kind of resurgence. I mean, we very much battled the 1970s callers in regards to inflation, and we're right on it, essentially citing the fact that there's a different set of ingredients going into this kind of inflationary scenario. So I wanted to start on that because major things are taking place. People kind of want Jerome Powell out so that the next individual can essentially pump their bags and be a bit more lenient towards quantitative easing. However, what we've seen is bags getting pumped under the context of extremely high interest rates. And that perhaps tells you everything you need to know about the fact that nothing is going to stop this train. It is very obvious to many people now that the game is one of money proliferation, and you need to move into things of value in that scenario. And they're trying to sort of introduce stable coins to combat that to a degree. We've got some really interesting things to share with you. We're going to be looking at what CEO of JP Morgan's asset management has to say, and Vanguard's response. They essentially say, like, we don't understand how to value Bitcoin or what the value of a Bitcoin could be. And that goes more broadly to the crypto space. People are looking at these assets like stocks. Actually, these assets can far exceed the prices of any one stock. Bitcoin is on its way to do that. The largest stock in the world is obviously Microsoft at $4 trillion. I think it touched. It might be a little bit down from that now. But Bitcoin's 2.5. I think it will engulf Microsoft's market cap and then set the broader trend for other cryptos to do so. Because stocks are investment vehicles. Yes, there is some usage and utility in regards to financial products or how you may leverage them. But cryptos have all of those properties, but actual usage and utility, at least the ones that are going to impact the world in a big way that we talk about. So I don't think anybody, including myself, is sure how to really value that in the world that we're moving towards. Certain cryptos' value is going to drive ultimately on their success, like XRP, for example. We also know that the empire is striking back. The Banking Policy Institute has essentially tried to get clearer guidance following the Genius Act that stablecoins essentially shouldn't bear yield. And the reason being is because, well, then what would be the point in kind of bank deposits and banking? And they've wrote a letter which we're going to look at. The BPI, which is the Banking Policy Group, the chair of that is Jamie Dimon, funnily enough, from JP Morgan. You've got Bank of America on there. You've got BNP Paribas. You've got BNY Mellon, Capital One, Citi, Goldman Sachs. You know, they're all essentially a part of this association, Wells Fargo, Bancorp, and they're kind of striking back or wanting clear regulatory clarity on stablecoins to make sure that they don't offer yields. Why would, I mean, you know, it's kind of like money doesn't offer yield unless you put it in certain accounts, often that you can't spend freely. There's a kind of effort to fight back against this, because really what would be their role then? And it would kind of jeopardize the whole banking system, or potentially put cracks in it. Grayscale obviously filed for a ADA and Hedera ETF now, and then we'll finish things off on a little bit of TA. Things playing out beautifully. Let's dive over to a post now from Nate Garcia. Great guy to follow. Very good on ETFs. He says, CEO JP Morgan Asset Management on whether they could consider launching spot Bitcoin and Ethereum ETFs. Vanguard's response, significantly higher vol than the S&P 500. No income, no intrinsic value. We don't know how to incorporate it into an investment. Here we go. Yeah, listen, I think we have a guiding principle around what types of ETFs we will launch, and we're going to launch ETFs that we believe are durable and have a strategy for how to incorporate into a long-term investment strategy. Now, I know that may sound kind of boring, but boring can be quite a successful investment strategy. Some people prefer boring. So that may mean that we lose some trendy, fatty ideas. This has got to be Jamie Dimon speaking, or JP Morgan. I think that cryptocurrencies are quite a speculative investment. I would agree with that. Investment in quotation. Wow. And it has significantly higher volatility in the S&P 500. No income, no intrinsic value. We don't know how to incorporate it into an investment. Okay. And it's ironic, because somebody that studied like portfolio management like myself, you want to unlock my portfolio, do become a Patreon, you'll know that actually you want to get uncorrelated assets that are speculative in your portfolio. You don't want to go too risky, but something like Bitcoin and Ethereum has kind of been tried and proved at this point, and other altcoins, I'm certainly positive on or confident on. But you actually want to go and seek alpha, which is getting those uncorrelated assets, even if it's a small portion, and they don't see the strategy for that. They go on to say, I'm not saying it's a bad thing. I'm just saying we don't see a way that we have some analysts who come in, and one of the projects we always give them is give us an investment thesis around crypto, Bitcoin, and they come back and say, we can't tell you how to value a Bitcoin. Can anybody really? I mean, it just depends on its kind of ability really to capture the world's value and to bring it onto its network. And that's Bitcoin's value really, is the belief in it and the value that it attracts. And so that's the premise around our investment capabilities. And listen, there's a lot of ideas that people are launching. Water ETFs, animal spirit ETFs. That doesn't mean they're good ideas. I'm not sure about any of those. And we're going to stick to those things that we make sense of for investors. And that's the discipline we bring to our product development efforts. So still very kind of hostile towards this. It's very interesting actually talking about, I mean, JP Morgan's obviously the kind of leader of the Banking Policy Institute is Jamie Dimon. In digital asset market structure legislation, it's important that the requirements in the Genius Act prohibit the payment of interest and yield on stablecoins are not evaded. Wow. So stablecoins are an evolution of money. They're going to be used in a big way. They're going to help to dollarize the world, which Peter Thiel put forward that technologies could do back in 1999. I've got some great stuff coming out for you guys on all of that, so do become a subscriber. But essentially, they're closing the payment of interest loophole for stablecoins. So they are protesting hard, obviously because banks offer this in terms of products, the ability for people to earn yield on stablecoins, even though those stablecoins are backed by yield-bearing products that kind of should go to the individuals who own them, not the bank essentially facilitating them. You can self-custody your own stablecoins, which means you should kind of get the yield on them because you don't need a bank to do that. However, banks are basically saying, no, that can't be the case. We need to be relevant. And this is them fighting back massively. It says, and we'll zoom in a little bit here. It's from the 12th of August. As policymakers consider digital asset market structure legislation, it is important that the requirements in the Genius Act, now signed into law, prohibit the payments of interest and yield on stablecoins are not evaded or undermined. The background, payment stablecoins do not substitute for bank deposits. money market funds, or investment products. And payment stablecoin issuers are not regulated, supervised, or examined in the same way. These distinctions are why payment stablecoins should not pay interest the way highly regulated and supervised banks do on deposits or offer yields as money market funds do. Bank deposits are an important source of funding for banks to make loans. And money market funds are securities that make investments and subsequently offer yield. Payment stablecoins serve a different purpose as they neither fund loans nor are regulated securities. This is all about the banks essentially trying to stay relevant in this and say, okay, the yield aspect of things. What this shows is a panic from the banking sector about stablecoins and crypto fundamentally changing it. They talk about flight risk and opportunity costs. The Treasury Department issued a report in April estimating that stablecoins could lead to as much as $6.6 trillion in deposit outflows. Wow. And that's people moving away from banking to crypto. Depending on whether stablecoins are able to offer interest or yield. With affiliates of stablecoin issuers or exchanges still being able to pay interest on stablecoins, the risk of significant deposit flight is even greater. This, by the way, guys, I'll give you a quick list of who's a member of this. Again, Jamie Dimon is the board chair, obviously from JP Morgan, Bank of America, BM Partison, BNY Mellon, Capital One, Citigroup, Citizens, 53rd, First Horizon, Goldman Sachs, Huntington, M&T Bank, MUFG, Regions, Truist, US Bank Corp, and Wells Fargo. You also have other jurisdictions like Barclays, so on and so forth that are involved in this. And these guys are fighting back hard to stay relevant. This shows major panic. So it says why it matters. Banks power the economy by turning deposits into loans. So money creation. Incentivizing a shift from bank deposits and money market funds to stable coins, because they're not the same thing, but they're essentially backed by it, would end up increasing lending costs and reducing loans to businesses and consumer households. Potential for invasion. The Genius Act contains a prohibition on stablecoin issuers offering interest or yield, as well as other financial and non-financial rewards to holders of stablecoins. However, without an explicit prohibition applying to exchanges, which act as distribution channels for stablecoin issuers or business affiliates, the requirements in the Genius Act can easily be evaded and undermined by allowing payments of interest indirectly to holders for stablecoins. These arrangements between stablecoin issuers and affiliate exchanges, often jointly and explicitly marked to consumers, will undermine the Genius Act prohibitions regarding payments of interest and yield. The results will be greater deposit flight risk, especially in times of stress. That will undermine credit creation through the economy. The corresponding reduction in the credit supply means higher interest rates, fewer loans, and increased costs of Main Street business and households. They are never going to set you free from the banking sector. And what that shows to me, and this is literally from the Banking Policy Institute, which has all these big banks. Remember, JP Morgan, very much, the board, the chair of it, they're basically worried that stablecoins and this technology is going to undermine banking, and it should really. It should shake up banking entirely. And it just also shows that this is far more about control really than anything in regards to the banking sector. So very interesting. Wanted to share that. A little bit more of a cheery note. Grayscale registers for Cardano and Hedera ETF in Delaware, indicating it may soon file for a spot Cardano and Hedera ETF. And I think we are going to get those broader ETF acceptances. September is my guess. From a price point of view, guys, just expect continuation. Don't get shaken out. We spoke about the bull flags that we were looking at a time when people were really upset about or really worried about tariffs and things like this. And we said, it's largely, the bigger picture is a positive one, and these are playing out as you'd expect. Total cryptocurrency market cap, excluding Bitcoin, is on the cusp of breaking into price discovery. And I think this is extremely significant. Wherever you look in the cryptocurrency space, a very bullish pitch. Obviously, Ethereum has broken out now. It's just an unbelievably good time to be in the crypto space. And I think people are going to make a lot of money with this. Also, BTC DOM, very much in phase 3 after this sort of head and shoulders setup. So that's it from me, guys. A lot of interesting things, a lot of big things going on, which is why I think it's important to be a technical analyst, because you can essentially ignore all of that. I mean, you don't want to ignore it, you want to pay attention to it, but go off of what you see setting up in the charts, and the narrative is ultimately going to follow, and often contradicts price action. So you might have a negative narrative, but price is going up, and that's ultimately because, the media doesn't dictate the prices of things, smart money does. We're very much on the right side of the markets. Ladies and gents, that's it from me. Interesting that the banking empire is, kind of worried about crypto, and also trying to. I don't really understand from the banks wanting to protect their deposits. Likely so you don't get bank runs and things like this. But why wouldn't you want people to get the most out of their money? Why wouldn't you want them to earn interest so that they can at least combat somewhat the inflation and money proliferation that the banks directly cause? Well, it's because this system is all about control, guys. That's it from me. I'm going to love and leave you. Thanks everyone for watching. I'll see you all in the next one.